The saying goes, it's a recession when your neighbor loses his job and a depression when you lose yours. However, economists and market participants tend to use economic data like the non-farm payrolls to gauge the health of the economy and how to navigate markets. Let's get into why the non-farm payroll or jobs report is crucial for futures traders. Whether you are trading indices, currency futures, or commodities, understanding the NFP is crucial for navigating the market's reaction. Let's begin. So what exactly is the non-farm payroll report? The NFP is part of the employment situation published by the U.S. Bureau of Labor Statistics. The non-farm payroll provides key data on how many jobs were added or lost in the United States, excluding certain sectors like agriculture. Typically, this is released on the first Friday of every month and gives traders insight into the health of the U.S. economy. Why is the non-farm payrolls important for traders? When the employment situation is released at 7:30 a.m. Central Time, markets often experience sharp movements as traders react to the headline numbers. This is especially true for futures markets, where volatility can spike. However, it's not just about the immediate reaction. How the market interprets additional data like wage growth and unemployment rates can shape trading patterns for days or even weeks after the report is released. The non-farm payroll report directly impacts markets' expectations for economic growth, inflation, and Federal Reserve policy. For example, strong job growth could signal an expanding economy, which might push index futures higher. On the other hand, weak job numbers could spark concerns about a slowdown, affecting everything from equity to commodity futures. Now let's break down this report. While the headline numbers, which is the total numbers of jobs added or lost, gets the most attention, there is more to the report. Wage growth and unemployment rates provide deeper context. For instance, even if job growth is solid, stagnant wages or rising unemployment can shift sentiment. Futures traders need to assess all of these factors in order to gain a deeper understanding of potential market reactions. Okay, let's unpack this with an example. Imagine the next non-farm payroll report shows at 350,000 new jobs, far exceeding the forecast of 200,000. This stronger than anticipated result could lift equity futures like the S&P 500, as traders anticipate continued economic growth. Conversely, if the NFP comes in far below expectations, you might see a drop in those same markets, with traders reacting to potential economic weaknesses. Now let's look at some other important indicators to watch. While the non-farm payroll is key to follow, it is not the only report that traders rely on. Leading up to the NFP's release, ADP releases their National Employment Report, which tracks private sector employment. Each Thursday morning, the Department of Labor releases the initial jobless claims, which is the number of employment insurance claims received. These numbers both can offer additional insights into the labor market. Staying informed about these reports can help traders form a clearer picture and better prepare for potential market moves when the NFP is released. In summary, the employment situation and non-farm payrolls are essential for futures traders and provides crucial insights into the U.S. economy and its influence on market sentiment. By understanding the full scope of this report, traders can better navigate market reactions and make more informed trades. Thanks for watching. If you have any questions about the non-farm payroll report or want to discuss futures trading, connect with the EdgeClear team at the link in this description. See you all next time and happy trading.